Something strange just happened in the silver market. In a matter of minutes, massive sell orders suddenly appeared. Thousands upon thousands of paper silver contracts dumped into the market all at once. The price collapsed almost instantly. Not gradually, not naturally, just one violent move. But here's the real question. Why would anyone trying to sell silver flood the market like that, knowing it would crash the price against themselves? No rational seller behaves that way, which raises a disturbing possibility. What if the silver market isn't behaving like a real market anymore? What if price discovery has been replaced by something else entirely? Today, we're going to break down what really happened, why these massive silver dumps keep occurring, and what it reveals about the hidden mechanics of the global financial system. Because once you see how the silver market actually works, you may never look at the price chart the same way again. Context. What just happened in the silver market? Over the past few years, silver has experienced some of the most unusual price behavior in the entire commodity sector. On one hand, physical demand for silver has been exploding. Industrial demand continues to grow as silver becomes increasingly critical for modern technologies, solar panels, electric vehicles, semiconductors, and advanced electronics. At the same time, investors around the world have been accumulating physical silver as protection against inflation, currency debasement, and financial instability. Many national mints have reported record sales of silver coins. Supply deficits have also started to appear. In several recent years, global silver demand has actually exceeded new mine supply. In a normal market, that kind of imbalance should lead to one thing: higher prices. But instead, something very different keeps happening. Every time silver begins to rally, massive waves of selling suddenly appear. These sell-offs are not gradual. They are sudden, aggressive, and often occur during the quietest trading hours of the day. The result? A violent price collapse within minutes. These events have become so common that many traders now refer to them as silver smashes. And each time it happens, the same question returns: who is doing this, and why? To understand what's really going on, we need to look at how the silver market is actually structured. Most people assume that when they see the price of silver on a screen, that price reflects the real buying and selling of physical metal. But that's not entirely true. In reality, the price of silver is primarily determined in the paper market, specifically through futures contracts traded on exchanges like the COMEX, which is part of the CME group. These contracts allow traders to buy or sell silver that they may never actually intend to deliver or receive. It's essentially a financial bet on the future price of silver, and the scale of this paper market is enormous. At times, the number of paper silver contracts in existence represents hundreds of millions of ounces of silver. But here's the critical detail. The amount of physical silver that actually exists in exchange vaults is only a tiny fraction of that. In other words, the paper silver market is massively leveraged. Many analysts estimate that there can be dozens or even hundreds of paper claims for every ounce of real silver. Now think about what happens when a large institution suddenly sells tens of thousands of paper contracts at once. That action instantly floods the market with synthetic supply. Even though no physical silver is moving, the price collapses because the market suddenly believes there's a massive wave of selling pressure. But the metal itself hasn't changed. This is why those sudden silver dumps are so powerful. They don't require physical silver. They only require paper contracts. And because these contracts can be created and traded electronically in enormous quantities, the price can be moved very quickly, sometimes within seconds. Now let's return to the strange part. When these silver dumps occur, they are rarely executed in a way that maximizes profit. Professional traders normally break large orders into smaller pieces. They do this to avoid moving the market against themselves. But in the silver market, we often see the opposite: gigantic orders dropped into the market all at once. Sometimes during extremely low liquidity periods, like late at night or early morning, that guarantees maximum price impact and minimum profit for the seller, which suggests something important. These trades may not be about profit, they may be about price control. This possibility isn't just speculation. Over the years, several major banks have faced investigations and penalties for manipulating precious metals markets. One of the most well-known cases involved JP Morgan Chase, where traders were accused of using a tactic called spoofing. Spoofing involves placing large fake orders to influence the market and then quickly canceling them. In 2020, the U.S. Department of Justice charged multiple traders with manipulating gold and silver futures markets over several years. The case resulted in billions of dollars in penalties and settlements. But many analysts believe those cases may have only scratched the surface, because the structural incentives inside the paper metals market remain largely unchanged. The same leverage, the same trading systems, and the same massive institutional participants. What makes this situation even more important is the changing role of silver in the global economy. Unlike gold, which is primarily a monetary metal, silver is both a monetary metal and an industrial metal. It sits at the intersection of finance and technology. As the world transitions toward renewable energy, silver demand is rising rapidly. Solar panels require silver for their electrical conductivity. Electric vehicles rely on silver in multiple electronic components. High-speed electronics and artificial intelligence hardware also depend on silver's unique properties. At the same time, global debt levels have reached historic highs. Central banks have expanded their balance sheets dramatically over the past decade. Institutions like the Federal Reserve, the European Central Bank, and the People's Bank of China have all injected massive liquidity into the financial system. Whenever monetary expansion accelerates, investors tend to look for assets that cannot be printed. Gold and silver historically play that role, which means the demand for precious metals can rise quickly during periods of financial stress. And if that happens while physical supply remains limited, the pressure on the silver market could become intense. This is where the difference between the physical market and the paper market becomes extremely important. Paper silver can be created almost instantly. Physical silver cannot. Mining new silver takes years. Exploration, permitting, construction, production. And many silver mines are actually byproducts of other mining operations like copper or zinc. So the supply response is slow. If physical demand suddenly accelerates, the paper market may not be able to suppress prices indefinitely, because eventually someone will want delivery. And if too many participants demand physical metal at the same time, the leverage inside the system becomes a risk. This is why some analysts closely watch inventory levels in exchange vaults and physical bullion markets. Those numbers can reveal stress building beneath the surface, even while the price chart appears calm. So what does the future look like for the silver market? There are several possible scenarios. The first scenario is continuation. The paper market continues to dominate price discovery. Large institutions continue to influence price movements, and silver remains volatile but contained within a controlled trading range. This is essentially the status quo. The second scenario is gradual tightening. Physical demand continues to grow faster than supply. Inventories slowly decline, and eventually the market begins to price silver higher as shortages become harder to ignore. But there is also a third possibility, a sudden repricing. If a major financial event triggers a rush into precious metals, or if industrial demand spikes unexpectedly, the paper market could face a moment of stress. In that situation, traders holding paper contracts may try to convert them into physical metal. And if too many participants attempt that at the same time, the imbalance between paper claims and physical supply could become very visible. Markets that rely on leverage tend to appear stable until they suddenly aren't. And when that shift happens, prices can move far faster than most people expect. But perhaps the most important question goes beyond silver, because the same structure exists in many financial markets. Derivatives, leverage, and synthetic supply play enormous roles in determining prices, from government bonds to currencies to commodities. The modern financial system is built on layers of financial claims, many of which are far larger than the underlying assets themselves. Most of the time, this system functions smoothly. But during periods of stress, those layers can begin to matter, which is why understanding the hidden mechanics of markets has become more important than ever. So here's the question. When you see those sudden silver price crashes, do you think they reflect real supply and demand? Or are they signals of something deeper happening behind the scenes? Is the silver market still functioning as a true price discovery mechanism? Or has it become something else entirely? Let me know what you think in the comments. Your perspective might reveal insights that others haven't considered. The silver market may look simple on the surface, a metal, a price chart, buyers and sellers. But beneath that surface lies a complex financial structure built on paper contracts, leverage, and institutional power. And occasionally, we get a glimpse behind the curtain, a sudden price smash, a massive contract dump, a moment where the mechanics become visible, whether these events represent normal market activity or something more deliberate. One thing is certain, understanding how markets truly function is no longer optional, because in a world of rising debt, aggressive monetary policy, and growing geopolitical uncertainty, precious metals are no longer just commodities. They are signals. Signals about the health of the financial system itself. And sometimes, those signals are telling us far more than the price chart reveals. This is the Screte Economy. And the deeper you look into the global financial system, the more you realize the real story is often hidden beneath the surface.